Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, June 10, 2018. We're looking at a daily chart of the SPY, or Spyders, which is the proxy for the S&P 500. As you can see today, and we discussed this in last night's video, the market went up to fill the gap that we identified at 278.73. The market made slightly higher high today. The high was 279.01, and that makes sense. The market went to the next big round number at 279, poked through it by a penny, and then backed off a little bit, but finishing near the highs of the day. That's not surprising, since when the market is close to an open gap, it does have a tendency to fill those gaps. Most gaps that are open will be filled at some point in time. Doesn't mean a gap has to be filled tomorrow, next week, or next month, but over time, most gaps will get filled. What's also important is where we are on the chart. So we're in what's called a double top area that comes just short of $280. And that double top is from the top that was made in this area here from the middle part of June. So the market sold off. We went down for about 2.5 weeks, about 12 trading sessions or so. That's common, normal behavior. You can see, and I'll just repeat this since we've talked about this before, but I think it's important to realize the move up here was between 2 and 3 weeks. The move down here was the same, between 2 and 3 weeks. Slightly less here, here a little more than 2 weeks, here same deal, between 2 and 3 weeks. Here we are again between 2 and 3 weeks, and you can see a pattern developing in the market. Even here on this big decline, it was about 3 weeks down. I think a day less than 3 weeks of activity. Now, let's go ahead and reiterate what was discussed last night. The question is this the next leg higher in the market? Well, it's obvious that the next leg higher at least was underway, if not complete. And we'll talk about that in a second. But right here, from the low that was made the other day, a little bit more than the other day, it was about 2 weeks ago, the market staged a pretty good rally to where we are today. We're into this double top area. Now, last night, I discussed the fact that if this market was going to continue higher, we would see the market reach likely $285, give or take a little bit on either end. That's the next gap fill that's all the way up here. Now, is the market going to get there? We don't know that for sure. I have an opinion that the market is not finished going higher yet. That doesn't mean it's going to happen all in one bite. We talked about that. Markets ebb and flow. You're not going to see the market run in a straight line from all the way down here where we were at the end of June all the way up to 285. That's not going to happen. You're going to have ebbs and flows. You're going to have backing and filling along the way. Now, is this double top area a natural point of resistance where the market is likely to be rejected from on the first run up to that double top? And the answer is, under normal market conditions, the answer is yes. Normally, we'll have some kind of a retracement if we're going to make another leg higher. Either a retracement of a portion of the move from here to here, so maybe it's a third, maybe it's a half, maybe it's more. So let's say we retrace the portion of this move. That's the market's way of resetting itself, building energy for another move higher, just like that. Alternatively, maybe the market just goes sideways for a while, builds some energy for another push higher, sideways consolidation. Maybe it puts in a bull flag pattern. That's totally possible, but it is unlikely that we're just going to blow through this area without finding any kind of resistance whatsoever. It's a natural area of resistance, a double top area. On the way down, if we should pull back, a natural area would be this gap right here. We just discussed gaps. There's a gap fill that needs to happen right down here. That happens to coincide roughly with a normal garden variety retracement, a little bit lower than that. Happens to be the 20-period moving average. That would be common, normal market behavior. Now, something interesting is going on, so it's worth it to discuss it in this video. And what's happening is, as I make this video, the futures are actually down quite a bit from where we closed the regular session. Here's a chart, the daily chart of the S&P E-mini futures contract. we're already down 20 points in the electronic or Globex session. Now, is there a piece of news tied to this? You guys know how I feel about news. Chances are there is some piece of news that will be tied to this kind of activity. Maybe it's news on a tariff issue. And I've said it multiple times, the likely scenario is that the tariffs are more of a sideshow than anything else. It's not really the cause of the market going down or the market going up or sideways or any which way. And the reason I say that is, each and every time the market went down, the media wanted to pin it on the tariffs. And believe me, I understand that this is a hard concept to wrap our heads around, and everybody doesn't have to agree. I'm telling you that this is the way I look at the market. I always let the charts dictate what the highest probability next move in the market's going to be. So the way I look at it is, it's common normal market behavior for us to be rejected on the first run up to a double top area right here. So this is the same S&P contract, happens to be the futures contract, but it's the same double top and it's the same rejection that we would expect under normal market conditions. So nothing crazy is happening here. The futures are down 20 points. It's not that big of a deal. Look how much we've been up since June 28th. From the low made on June 28th to today's high, the market, or the S&P, the futures contract, is up about 104 points. I think that qualifies as a little bit too far, too fast, and therefore we're pulling back. Under normal market conditions, we'll do some kind of a retrace. Now, if I'm wrong and they want to take the whole thing back, then we're going to make new lows, and that changes the picture, and we'll address it if that begins to develop. But that's not what I expect at this juncture in the market. It's just interesting to me, is the market pulling back because of whatever news the media wants to assign it tomorrow? Maybe it has to do with the China tariffs, maybe it doesn't. Or maybe it has to do with the fact that we hit a double top. It all depends on how you want to look at the market. If you believe that the market trades the majority of the time on technicals, then it was the double top. And a news event can certainly spark the market. I'm not denying that that takes place, but in large part, the market's going to move based on the technicals. You'll see if this is a normal garden variety pullback, we'll pull back a third or maybe half of that move, 30, 50 S&P handles. Everybody will be scared. Everybody will be calling for new lows. And then all of a sudden, the market will turn around and it'll head back up in the other direction. And all of a sudden, the tariff news will go by the wayside and it won't be as important as it was the day or 2 days prior. That happens time and time again. Case in point, the tariffs were officially imposed and China imposed their tariffs on us right here. And the market went up strongly for 2 days in a row, right around the 4th of July holiday. So was it the tariffs that sent the market higher? The same tariffs that sent the market lower, according to the media? I just find it fascinating that the media always has to assign a reason for the market being down. They can't get a grip on the technical aspect of the market, and I understand that. They're trained to look for a piece of news for the reason the market moved, whether it's up or down. And the best part about the market is we all can choose individually whatever we want to believe. It really doesn't matter in the end. The price is the absolute arbiter in the end for the market. Price is the determinant. Price was at a double top. Now we're pulling away from the double top. Whatever we want to believe the reason is up to us individually. I believe we hit a double top, which is the reason why price is, at least temporarily for now, being rejected from that double top. Where we wake up tomorrow morning and find the market is a whole nother story. There's been plenty of times, it happens all the time. Futures can be down overnight, and by the time the market opens at 9:30 in the morning, we're right back to where we started from at the close the day before. Who knows what's going to happen? That could happen, or we could be down another 40 handles in the S&P. Either way, we just have to be aware of what the charts are telling us and where the money flow is. That's what's important. Just show you an intraday chart. Here's a 10-minute chart of the futures contract, and you can see here, all of a sudden, we just had a waterfall decline. Now we're finding a little bit of an oversold bounce. We don't know where this is going to wind up by the morning. We could be down significantly farther, or we could retrace a portion or all this move. Either way, we'll find out when the market opens on Wednesday morning. Let me take a pause here for a second and thank everybody for continuing to participate in making comments and providing your thoughts underneath these videos. It's helpful to me. It's helpful to the entire community. I love the interaction, so please keep up the comments. Keep them coming. I'm going to answer each and every one of them. I appreciate everybody's participation. In addition, please hit the like button on the video and also share the video with those people you think can benefit from this information. I'm trying to pay it forward a little bit. I'd like everybody to pay it forward if they can as well. Before we move on, we'll take a look at the hourly chart of the Spyder, and I'll just show you what I'm looking at in terms of potential support for tomorrow. Obviously, it depends on where we open, so I have no idea where we're going to open tomorrow. However, just eyeballing the chart, you can see here we were making a bullish pattern at the top end of the chart right around that gap fill. We basically traded in and around that gap fill all day long. Where the market is right now, as you can see on the top here, trading at about 277. So we're right about here, and you have a couple of important areas that I'll point out. So you have here what's called a gap window, and then you have a gap fill down here. Those are natural areas that the market's likely going to want to go to or run to tomorrow. So you have an important area here. You can see this coincides with this gap window. So the market was telling us, for example, right here, that that price level was important a couple of times. We rallied up to that price level, sold off from it, rallied again, sold off from it. Then we came back to it, and guess what? We jumped over it in order to get through an important number. That happens a lot. We've talked about that before. So it would be common, normal market behavior for us to come back and test that important number. You have the gap fill, and then you have the moving averages start to come in. Here's the 200 moving average coming in right underneath $275. And if I just eyeball this, I can tell you without a shadow of a doubt that this is a normal garden variety retracement. So if we came somewhere down in this area, that would be common, normal market behavior. Now, something else is going on this week that I think it's worth making mention of. As we go back to the daily chart, I want to remind everybody, and we talked about this at the time, but what was taking place right up here, the market was topping out, and where was it topping out? Right around another double top area, right? So this was a double top dating back to this peak made in March. Okay, so we came back up to it, and on the first hit, we're usually going to get rejected at a double top, which is exactly what we just discussed up here. But also, that was right before the summer solstice hit, and the market really sold off after the summer solstice. We talked about it at the time, and you don't know how the market's going to react to these type of lunar events. Sometimes they don't act or react at all. Sometimes they sell off. Sometimes they make a trend change, but sometimes they can have an acceleration. So it's not something we can trade off of, but it's something that we want to note. Something that we want to be aware of. Well, we have another event late this week on Friday. We have a new moon, also a solar eclipse. Can the market change trend during that period of time or after that period of time? Absolutely. Do we know that that's going to happen? Not necessarily. It can be an acceleration point, or it can be an area where the market changes trend. Also, coming on Friday is the beginning of earnings season. And in the beginning of earnings season, we're going to start off with the banking stocks, namely JP Morgan, and usually, and I didn't double check this, usually Bank of America and Wells Fargo and a couple of others will report on the same day. So that could also set the tone for the market on Friday and into next week. Into next week, we're going to start to get a lot more earnings, and then they're going to come fast and furious as they always do. And this is what my traders in the lazy gap trader are waiting for. We're waiting for earnings season because that's an area or a period of time where stocks will move. In order to have opportunity in the market each and every day for our intraday traders, we need stocks that are moving. Earnings season is the perfect recipe for that each and every time. So all my gap traders are looking forward to getting plenty of trades for the next couple of months through the heart of earnings season. And the best part about that is we don't care what the market's doing. Market up, market down, doesn't make any difference. All we care about is identifying the stocks that are in play during that day, and can we identify an area where these stocks will trade to. If making a big move, we can find a support area or a resistance point and make a trade because we're expecting a price reaction in the other direction. During earnings season, it's not out of the ordinary for us to have at least 2, sometimes 3 or 4 trades a day. All right, putting that aside, let's go over to the IWM. Now, here was the tell. The IWM was down today, and it was down significantly more than any other market was down. In fact, most markets were up to flat today, but the IWM was down. Let's look at an intraday 10-minute chart, and you can see here, here's the peak of the day. The IWM puts in a topping tail. It goes sideways for a while, and then it sells off, finds a little bit of a low, and tries to rally towards the end of the day. But this was the tell. When you compare this chart to the Spyder chart, you can see it doesn't even look close. The IWM was trading down most of the day, and for the most part, the SPY or the S&P 500 traded sideways. You know how I feel about the IWM. It's my favorite market leading indicator in either direction. And here we approached double top. We didn't quite get to the double top area, and the market found a high today, put in a tail candle early in the morning, right out of the chute, and traded down for the majority of the day. That was a tell that something was amiss, that the upside was probably going to peter out, and that's precisely what happened thus far. Again, I'm not expecting a major decline. I think it's just a pullback in the making. Time will tell. But again, there's nothing wrong with the IWM from a technical perspective. We're above all the moving averages. We're near all-time highs. It's common, normal market behavior for the market to simply ebb and flow. And that's exactly what I think is happening here. I'll tell you what, though. I think the IWM as a market indicator is the best kept secret across the markets. Almost nobody uses the IWM as an indicator. They use all kinds of indicators, all kinds of stuff, MACD, RSI, this, that, and the other thing. And guess what? I don't use any of that stuff. The IWM is by far the single best market indicator that I've found. And I guess it's not a secret any longer because I'm telling everybody about it. But so be it. I want you to use it. I want you to be successful in the markets. That's the whole point. And remember, there were a few days ago, we did the same thing with the IWM in the other direction. It was right here where the market was down. The S&P, the Dow, the NASDAQ was down for the day, and the IWM was basically flat to slightly positive that day, and I said something is amiss. In fact, I think I even titled the video Strange Markets or Market Acting Strange, whatever it was, and that was the reason we talked about it in that video, and then we saw 2 or 3 heavy up days in the market, and it was led by the IWM. Now we flipped over the tape, and all of a sudden the IWM is telling us the other direction is at hand. The IWM is my favorite market leading indicator, and now you see why. My second favorite market leading indicator, the transports. Interestingly enough, the transports had a tremendous rally yesterday, but look where we went. We went right into the convergence of these moving averages. And I believe we talked about it, the fact that this was going to be a tough area for the transports to get through for a number of different reasons. A lot of overhead support. It was a natural garden variety retracement. It was into the convergence of the moving averages. And right here you see we actually were down a lot more than we finished the day. We only finished the day down 32 points in the transports, but they were down significantly more earlier in the day. They fought back but still finished negative. Very good rally off the low. Remember, we had this tail put in. We had a nice rally off that level, and all of a sudden now we've run into some natural resistance in the market. So do we go sideways? Do we pull back a little bit, reset the tape, and then build some energy for another move higher? That's what I think is taking place. If it's not and something else is developing, we'll know it by this. If the transports closes on the daily chart below the low of this breakup candle, then something else is developing and there may be some trouble at hand. Until and unless that happens, we're going to go with the up leg is not finished just yet. How about the Qs? Again, into a double top, right around this double top area. natural point of resistance. Not a surprise that we see the market stall out a little bit. So what did the Qs do? They put in a doji candle. If markets are weak tomorrow, we'll obviously pull back in the Qs or the NASDAQ market as well. But look where we are in the charts. We're near an all-time high. We're well above the moving averages. Again, technically speaking, nothing wrong with this market. It's normal, common market behavior. So we pull back a little bit. Normal garden variety retracement. Maybe we fill a gap. We have an open gap right here. That can be filled. The 20-period moving average will likely act as support on the way down if we can get that far. But there's nothing wrong with this particular market. There's nothing wrong with the tape. If we see some downward activity, you're obviously going to see the media turn on the market. They're going to cite the tariff wars or some other event that's taking place. It basically just gives them something to jabber about during the day. Nothing more, nothing less. Financials, XLF, we had a really nice, big, healthy up day yesterday. That took the market past and closed above the 20-period moving average. We have a natural point of resistance right here, a breakdown candle high. Where did we go today at the high? Right into that breakdown candle high, natural area of resistance. So it's normal for the market to kind of stall out at that particular price level. Maybe we go sideways, maybe we pull back a little bit, but until and unless we close below the low of this breakup candle, technically speaking, there's nothing wrong with this particular market. Now, when you look at the longer picture, the longer, larger time frame, the weekly chart, again, this market's not out of the woods yet. We can certainly turn down. That can certainly happen. But as you can see, over the last couple of weeks, the financials have been fighting the downtrend that's found on this weekly chart. So it's almost like the financials really don't want to break down. Can they go lower? Can they get to the area that we were originally discussing right around here and maybe even slightly lower down to the 100-period moving average around 25? Absolutely. Is that still a buying opportunity? Does that still represent very solid support for the financials? Yes, it should. From a weekly chart perspective, the financials certainly aren't out of the woods. We really need to get above and close above, for example, this 50-period moving average, which is the blue trend line, and then also the 20-week moving average, which is the red trend line. Until and unless we get above those trend lines, then the financials still have some overhead resistance and can come under some pressure. All right, let's flip over to the gold chart. We're still on the weekly chart, and you can see here, last week we had a pseudo doji candle, but we're not getting anywhere in gold. This could go sideways, setting up for another leg lower. There's just nothing great on the gold chart. When you look at the daily chart, we could be going sideways, preparing for another push higher. But where is that push higher going to take us? Maybe it only takes us to the underside of this upsloping trend line. Where does that trend line come from? Well, look where it comes from on the monthly chart. This is a potential breakdown which could bring much lower prices in the gold market. Unless we recapture this trend line and begin trading, getting above that trend line, this will generally promote lower prices in the gold market. Where are the next major pivot points? Well, you have some down here. We've already been there, so you can see where that was supportive of the market. Now we have one down here, and we have one down here. And that's really what's going to happen if these financials, if the gold market begins to break down further. If we don't recapture that trend line, the pressure will be to the downside. And for those gold bugs out there, don't shoot the messenger. I'm just the umpire calling balls and strikes. I'm just calling it as I see it. Now, we have a member that requested me to discuss a couple of charts that I don't normally talk about, silver and also natural gas. So I'm going to do it. It's not going to take that long, and some of you may be interested, some of you may not, but the silver chart isn't that dissimilar to gold. There's really nothing great on the silver chart. From a daily perspective, you can see we made a bottom, and this could be going sideways to make another push higher, but look what's waiting for us higher. You have the 20-period moving average curling down. That's going to be some overhead resistance. You have this particular high right here, just above the 20-period moving average, overhead resistance. More pivots, overhead resistance, also the 50-period moving average, the 100-period moving average, normal garden variety retracements, pivot top, pivot low, and your retracements are in here. So there's really nothing great in silver. The trend is down. It's certainly not up, and there's nothing positive or bullish about this chart. The weekly chart, it's the same routine. Look where we are relative to the moving averages. We're below all the moving averages. That means the trend is really gripped to the downside. From a support perspective, I would say you're likely to find some support at 1566, 1560, in that neighborhood, right where I put this horizontal trend line on the chart. However, we've been consolidating over that area for a long time. We kind of came close to it, bounced away from it a little bit. So I'm not sure how much support it's going to bring. I got this particular support level from a larger time frame. When you go over to the monthly chart, for example, you'll see here that you have a breakup candle low, and that low happens to be 1566. And, that particular low should be supportive of the market, but we've been hovering, and we've already hit it once, by the way. We've been hovering and melting down, so I'm not sure it's going to be supportive again. The next area of support would really be this double bottom area, right down here at 1450, 1455. If that doesn't hold, you're all the way down to a low of $10.81. Now, that's not going to all happen at once, but this is a market that's melting down. Unless it can catch a bid, unless it can catch a rally sometime soon, it's going to continue melting down. So net for me, I don't see a reason to be long silver, and I certainly don't see a reason to be short silver. It's down too much. You can't short something, what I like to call in the hole. So there's really no trade to be had in silver. Natural gas isn't much different. Below all the moving averages, nothing great on this chart. Where are we headed? Most likely for somewhere around the low of this breakup candle. That's natural for the market to want to come back and retest former or breakup candle lows and breakdown candle highs. So that's what I see coming in natural gas. You're likely to find a fair amount of support in this area. Not only is it a breakup candle low, but you also have a lot of support by virtue of the fact that the market found support in this general zone a lot of times for a long time. That's the market's way of telling you that that price level in and around that area is important. Will it be important again? Likely it will, at least for a period of time. But again, on this chart, nothing great to be had. Can't be long, can't be short. Here's the weekly chart, and what you can see here is that here's a breakup candle high, right? It's a breakdown candle high. And what did the market do? It rallied back in really a bearish wedge pattern to the high of that candle, and now it's trading away from it. What do markets like to do? Markets like to test breakup candle lows and breakdown candle highs. It happens over and over and over again. We talk about it each and every night, and now we're talking about two markets that we never talk about, silver and natural gas, and we're seeing the same thing. And there's to my point. It doesn't matter what chart we're looking at, what time frame we're looking at, all charts act and react the same way, and these are precisely the things that traders learn when they take my course at LazyEMiniTrader.com. They learn all these nuances and a whole lot more than I ever discuss in these videos. John, I wish I had more for you on natural gas and silver. I just don't. They're not great charts. There's downward pressure on both charts. Not sure what you're looking for, but there's the analysis as I see it. Just calling balls and strikes. Crude oil, not much change in crude oil. We're still hovering right around this $74 area. We're keep peeking our head into the hot zone and going back and forth. What this is really doing is it's making a sideways consolidation pattern. It's basically a bull flag pattern from this up move, and this will likely promote another move higher. That's okay. We're likely to get somewhere into the hot zone, and then we should be looking for signs and a signal of a trend change that should happen somewhere in the hot zone. Maybe we get up to 76, maybe even closer to 77, but really, north of 76, I would be surprised if we spent much time north of $76 a barrel. We'll see what happens if we get there, but that's my take in the crude oil market. All right, folks, I'm at a win tonight. It's everything that I intended to and wanted to discuss, so I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.